The Apollo program cost roughly $280 billion adjusted for inflation. The U.S. interstate highway system cost about $500 billion. This chart shows the current AI data center build-out, which is projected to exceed $7.6 trillion by the end of 2031. For the past 2 years, retail investors have crowded into the most visible layer of this project, pouring capital into the companies designing the raw AI processors. In June of 2024, a 25-year-old fund manager named Leopold Aschenbrenner published an essay predicting exactly how massive this infrastructure boom would be. He went long on those processing chips and took a $220 million fund to over $5.5 billion in about 12 months. But his most recent financial disclosures reveal an abrupt shift. He took out massive put options against the semiconductor giants that drove his initial returns, betting over $6 billion that these market leaders will fall. When one of the most successful winners of the initial AI chip rally begins betting billions against the names that made him rich, it suggests a high-stakes strategic pivot is underway among the market's elite players. Aschenbrenner's filings show he rotated his capital directly into large, long positions in physical infrastructure, specifically power generation and data memory. This move follows a core economic principle of industrial history. In any super project, the highest financial value eventually flows to the most severe physical bottleneck in the supply chain. While processing chips were the primary constraint in 2024, many analysts and executives now argue that the biggest physical hurdle for the AI industry is data memory. The most sophisticated capital is no longer bidding up the price of artificial intelligence itself. They are buying the physical constraints preventing it from expanding. An AI data center functions much like a human brain. It relies on two primary executive functions: raw processing power, which does the thinking, and memory, which handles information recall. You can scale the processing power infinitely, but if the system lacks the memory capacity to access and store the information it needs, the processors sit idle. A memory deficit will throttle the entire system. Data from Dell Technologies highlights the scale of this dependency. Between 2022 and 2028, the memory capacity required per individual AI accelerator chip is expected to expand by roughly 25 times. Simultaneously, the total number of these chips being deployed inside data centers is projected to scale by another 25 times. Multiplying these two variables results in a projected 625-fold explosion in total memory hardware demand within a 6-year window. While software code can scale across the globe in seconds, hardware requires factories and raw materials. This friction between digital demand and physical reality creates a massive supply squeeze. You cannot spin up new memory supply overnight. A new fabrication facility costs $20 billion and takes 3 to 5 years to reach production. The supply constraint is so severe that Nvidia's CEO, Jensen Huang, recently told memory manufacturers to build as much capacity as they possibly can, promising that Nvidia would consume every chip they could produce. For retail investors looking to target this specific physical bottleneck, the most efficient vehicle is the Roundhill DRAM ETF. This fund provides exposure to the global memory oligopoly: SK Hynix, Micron, and Samsung. Together, these three companies make up roughly 75% of the ETF. Holding this fund allows investors to position themselves across the exact resource that processor designers like Nvidia need to function, without taking on the risk of a single stock. If the projections from memory demand are this significant, it raises a natural question: why hasn't the market already accounted for it? Currently, Nvidia trades at a forward price-to-earnings multiple of roughly 30. The DRAM ETF, which holds the companies Nvidia relies on, trades at a multiple of around 8. This gap exists because many institutions still treat memory as a cyclical consumer electronics industry, tied to the sales of laptops and smartphones. But the data suggests that model is becoming obsolete. At companies like Micron, over 65% of revenue is now driven by AI data centers, shifting their business from consumer cycles to long-term infrastructure growth. The reliance on outdated financial models has created a pricing gap for investors who recognize that memory demand is now structural, not just seasonal. I have put my own capital behind this thesis, with a $10,000 position in the DRAM ETF at an average cost of just over $51 per share. The fund recently pulled back to its 20-day exponential moving average. In a multi-year industrial expansion, Technical corrections like this are often logical opportunities to build a position. If memory sector valuations eventually re-rate to match the multiples currently seen in chip designers, the math suggests a potential path for the ETF into the $150 to $200 range. However, this depends on hyperscalers maintaining their current spending levels. If AI data center investment slows, or if geopolitical tensions disrupt supply in East Asia, the memory sector would face significant headwinds. The early phase of the AI build-out was about processors. The next phase of this multi-trillion-dollar supercycle will be defined by the physical bottlenecks.